Hello and welcome to The Upside. I'm Jordan Chevalier. With labor markets still wobbly, both the U.S. Federal Reserve and the Bank of Canada announced quarter-point rate cuts. How have equity markets responded, and what is the likelihood of another rate cut being announced at the final meeting of the year in December? Joining the show today to take us through these key questions and highlight how they're shaping asset allocation is institutional portfolio manager and member of Fidelity's global asset allocation team, Ilan Kolet. Ilan, thank you for being here today.
Yeah, great to be here. Nice to see you.
So how have the markets reacted so far? We've seen both the Bank of Canada and the Fed for the second time in as many months cut rates by a quarter basis point. Let's take us through that.
Yeah, so what did we see yesterday, right? We saw, as you mentioned, we saw both the Bank of Canada and the Federal Reserve cut by a quarter basis point. Federal Reserve is now, their policy rate is now between 3.75 and 4, right? So materially higher than in Canada. The Bank of Canada, the overnight rate is now 2.25%, right? After many successive cuts from where they peaked out. What I found interesting about the discussion yesterday was, markets, I think, and investors sometimes can get ahead of themselves, and specifically related to the discussion in the U.S. It was around really this idea that the December rate cut was a complete lock and fully baked in. And what we saw yesterday was material pushback on that. Again, I have a very specific framework on how I think we should be thinking about central bank decisions. Between myself, David Wolf, David Tulk, we have a combined almost 20 years of experience working at the Bank of Canada, and we have a framework on how we think about these things, which I'm happy to get into. But to me, this idea that we are definitely getting rate cuts in December is not necessarily locked in, and it's not something we should assume.
Okay, and we'll talk about December a little bit later on. This cut specifically, did this cut sort of surprise you? What were you expecting, and what was the team expecting?
Yeah, so this was fully expected.
Sure.
I should say that at the start. But our team, we don't make specific point forecasts on specific Bank of Canada or Federal Reserve decisions. We have a general thought on the direction of travel for rates, right? And so we've believed for a while that rates were heading lower, both in Canada and in the US. They started heading lower in Canada earlier because of vulnerabilities and sensitivities in Canada, which were significant. And that was the right decision from the Bank of Canada. For the US, I remember at the start of this year, I was on a Fidelity Connects and I said the Federal Reserve would love to be done, meaning they would love to keep rates sort of somewhat restrictive. And the reason for that is there are really two variables that we should be thinking about when we examine a central bank decision. This will take a few seconds to explain, but I think it's worth really digging into. So before any central bank decision, whether it be the Bank of Canada or the Federal Reserve, there are loads of experts that we hear from. There's lots of ink spilled. But really, I think the way to simplify this is to think about the decision in terms of rates facing a central bank as a function of two variables. So handcuff yourself to two variables, inflation and unemployment, or inflation and the labor market in general. And so earlier this year, I said for the US, and even for the Bank of Canada, the Fed, the Bank of Canada would love to be done. And so for the Fed, the reason for that is inflation was very high. Inflation had rolled over and come down. And inflation was not yet at where they wanted that target inflation rate, where they wanted inflation to be. And so if inflation is slowly grinding down towards where you want it to be, you don't cut rates, right? You keep rates somewhat restrictive to push that inflation rate lower. Inflation moves very slowly. And that's the first variable, inflation. The second variable that we need to think about, again, handcuff yourself to inflation and unemployment, or the labor market. The second variable forced the hand of the Federal Reserve, or was enough of a factor that it forced the hand of the Fed in September, and now again. And that is, wobbling, as you mentioned in the beginning, and a slight weakening in the labor market, right? So the unemployment rate in the US has drifted higher. Job openings have come down. I would say, the labor market is not flashing bright red signals. It's a little bit difficult now with statistical delays and a government shutdown, but this is not, we're not flashing major warning signs, but there are, concerns, I would say, in the US labor market. And what that means, again, from an inflation and unemployment perspective, is cut rates, because you're not going to be stubborn on the inflation mandate and run the risk of being overly tight for the labor market, right? you're not going to be stubborn on the inflation mandate and be overly, and run the risk of an unemployment rate pushing much higher. In Canada, and then I'll come up for some air. In Canada, it's almost the same story with important differences. I said earlier this year, the Bank of Canada would love to be done. Inflation was low pre-COVID. It went very high. It's come down and is now roughly where the Bank of Canada would like it to be. This is what they even expressed yesterday. But the labor market is showing meaningful signs of cracks.
Ilan,
right?
you mentioned the U.S. government shutdown. Just briefly, maybe for our viewers, can you take them through a little bit about kind of what that means or maybe signs there as this continues?
Yeah, I mean, I would say it's an unproductive layer of uncertainty for policymakers, right? So because of sort of political gridlock, there's a government shutdown right now. There's, people can read all about that in the Journal and on Bloomberg. What it means for policymakers is it makes the decision that much harder, right? In the presence of murky statistics or the lack of statistics or even delayed statistics, you're forced to move to private sector, non-government labor market indicators and inflation indicators. I was at a conference a couple weeks ago in Philadelphia where I had a chance to introduce Chair Powell at the conference and sit with him at lunch. And he was very clear about this in his remarks and his speech. The gold standard for statistics are the government published statistics, right? From the Bureau of Labor Statistics, the Bureau of Economic Analysis, the Census Department in the US, and in Canada, that's Statistics Canada, right? At Tunney's Pasture in Ottawa, on Scott Street, where I spent way too much time. Those are that's the gold standard for incoming statistics for central bankers and policymakers. And in the absence of those statistics in the US, not in Canada, it makes their decision that much more difficult. They have to rely on private sector, labor and employment indicators, which again, those are complementary, but they're not as critical as the baseline statistics that the government is producing. And Powell, he had some interesting comments on this yesterday. He said, for some members, this means moving slower, right? So again, he talked in the press conference, he talked about, when you're driving through fog, for some people that's slow down, right? And so again, it's unclear what the lack of statistics means for the direction of policy going forward. For some people that means slow down, but there were some dissents as well. What I would say though in general is we shouldn't just assume that a December rate cut from the Federal Reserve is fully baked in. They're taking a data-dependent approach, as is the Bank of Canada, and they'll move slowly and cautiously with the flow of data that they have to work with.
Ilan, let's stay with that December rate cut. I'm reading a lot about one of Chair Powell's comments, and I have a quote here referencing the December rate cut. He said, "It is not seen as a foregone conclusion. In fact, far from it." I think a lot of people, I've even seen this referred to as sort of a December shocker in terms of a statement from Chair Powell. He usually doesn't make statements like this. But what do you think? What are your thoughts on that statement?
Yeah, so he's in it's a particularly difficult situation because, again, like we've talked about, investors and markets can sometimes sort of fully bake in and expect the result that they're really hoping for, right? And I don't think that's the right way to proceed, right? The way that we think about things is we work closely with our researchers. We have a 4-pillar research process, and that's how we think about things. The way to think about central bank decisions is, again, I mentioned handcuff yourself with inflation and unemployment. But, I spent almost 10 years there and David Wolf and David Tulk spent a lot of time there as well. The way that central banks make decisions for an upcoming rate decision is they have a base case, right? And that base case was discussed yesterday at the end of October meeting. And that base case is based on models and discussions with the business community in Canada or the US and incoming and the data flow that they have. And then they update that base case, iteratively as they move through time from October until the December meeting. And then after the December meeting, they have an update to that base case, and that base case is either better or worse, right? And so that's how central banks are updating the flow of information. So this idea that, there's a rate cut in October and it's fully baked in for December is incorrect. And Chair Powell was absolutely right in pushing back against that. The other thing that is difficult right now is, Federal Reserve board members, we don't want to get too nerdy here, but Federal Reserve board members can dissent, right? And you now have opposing dissents, right? You had a dissent from one voting member saying, actually, that 25 basis point cut should have been 50, and another one saying, actually, that 25 basis point cut should have been no cut at all, right? And so there's a spectrum of views on the Federal Reserve Board, and that's another thing to take into account. To me, that speaks like a widening dispersion of base cases, especially if that grows to more dissents, speaks to less certainty, right? That fog analogy, and that's a reason to kind of move sort of slower than what you'd expect.
That's very helpful, very insightful. Shifting now to an investor point of view. If you're an investor, you're a borrower, you're looking at all of this, what are some key things to watch, or what's sort of the angle there from an investor standpoint?
Yeah, so how are we thinking about this in terms of the funds that we manage for Canadian investors, right? So we're managing, about $103 billion in multi-asset class fund of funds for Canadian investors. We are always thinking about policy. We want to position for policy, not politics, right? And what do I mean by that? Policy is what we've just been discussing. Politics is, we don't have an edge in thinking about when the government shutdown may end and what decisions from the Hill or from the U.S. administration how that may affect things. We really have to use our 4-pillar research process to think about sort of the direction of travel and where we can find opportunities. So in the context of the funds that we manage, what I would say right now is we're slightly overweight equities. So in the context of the global balanced managed portfolio, 60-40 stock bond portfolio, that 60-40 right now is roughly a 65-35, slightly overweight tilted into equities. And we're finding opportunity in various areas, right? So we are slightly underweight US equities. And what that means is the 25% of that fund that is US equities, we're trimming to about 20, right? So still plenty of US equities, but given the political uncertainty and the underpinnings of US exceptionalism coming under attack, coupled with market concentration and valuations, we think now is the time to lean slightly away from the US and really give our security selectors in Europe more to work with. So we're overweight Europe. We are also now neutral Canadian equities for the first time, in a very long time, because as we discussed in our Q4 thought leadership paper, we sort of think in Canada it's darkest before the dawn, right? Most of the bad news, we believe, is priced in, and the path forward may not look as bad as what was just in the rearview mirror. Again, thinking about things like rate resets, right, which will definitely be affected by the decisions yesterday. Those rate resets that Canadian households have had to stomach for the last few years, we're now coming to the other side of that. And so maybe the worst is behind us. And the way that we think about that is you can add a lot of value, add a lot of basis points when things go from very bad to bad, right? And again, maybe things are sort of darkest before the dawn. The other thing I'd mention is around inflation. So we don't think inflation is fully conquered. We think there are still sort of upside risks to inflation. Inflation is stubbornly elevated in the US. It's not quite where the Fed would want it to be. And that's a reason why we need to own asset classes that protect the funds against the damaging effects of inflation. For inflation volatility, geopolitical risk, sort of political independence, questioning the political independence of the Federal Reserve, and dollar debasement, right? And it's unbelievable I'm talking about some of these things, but this is the reality we're in, and we have to own the asset classes that protect the funds and the investors against these effects.
We've talked a little bit about December, but looking even further ahead, as much as we can, sort of what's next for that rate story as far as you can tell? What are your opinions on where we might see, certain things happen into 2026? Yeah,
again, the phrase to keep in mind here is data dependency, right? So any expert, so-called expert that you see or hear from, on the networks or in the paper, talking about fine precision around the path of rates over the next 12 months, we should throw all the cold water we have on that, because that's not even how the central banks think about it, right? So now I don't want to say they don't have a rate path, right? Every single base case they have at every meeting will have a rate path back to their so-called neutral rate, but that gets updated with every rate decision, number one. And number two, the neutral rate of interest is an unobservable number, right? That can change based on the potential growth rate of an economy and how productive you are, right? And so in Canada, I would say the material concern is there has been a write-down at a pretty significant level for a long time because of the loss of potential growth associated with the damaging effects of the trade war, right? Again, 80% of our exports go to one place, and exports are 30% of our GDP. So 20% of Canadian GDP just by itself are exports to the US. Borders are getting thicker, and that's a long-term problem for Canada. And again, there's positive signs on forging trade relationships with other parts of the world, and ideally a resolution to the Canada-US trade spat. But in the meantime, growth has been marked down, right? Both in the near term and in the longer term, and that's problematic. And Governor Macklem talked about this. He said, I'm paraphrasing, but monetary policy is a blunt tool, right? So you have one variable that you can move up or down, essentially, and that can help mitigate inflation shocks. But in order to really get past this shock, we need to boost productivity, and in order to do that, you need to boost investment. And that's the role of fiscal policy, right? Fiscal policy, and we'll get a budget soon. So fiscal policy is what you need to sort of get shovels in the ground and boost productive investment to overcome the type of trade shock that we're observing right now.
Ilan, that's very helpful. You mentioned your thought leadership paper that is available now on fidelity.ca, and that's the Q4 thought leadership paper from the Global Asset Allocation team. Ilan, thanks so much for being here.
Yeah, super, thanks.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.